Hello and welcome to the Magpie YouTube channel. I'm Anthony Tran, a strategist at Magpie Invest. In today's video, we'll be discussing the current state of the US stock market and whether a market crash is imminent. Recent failures of US regional banks have left investors questioning the health of the US economy and the prospects for the stock market. However, it's important to understand that even the US economy is slowing, it doesn't necessarily mean the stock market will follow suit. This is because market directions can be independent of the economic climate, so the most crucial factor to consider is the valuation of the US stock market. Before diving into the valuation of the US stock market, let's discuss an often cited risk indicator, the US Credit Default Swap, CDS. The CDS is used to insure against default of the US government, and the wider the credit spread, the higher the perceived risk of a US government default, and the greater the cost to protect against it. Recently, the credit spread of the 5-year CDS has surged abruptly, hitting a new high since 2009, indicating that market participants view the current default risk of the US government as high. Although the spread of CDS in the US has risen sharply, it may not be a reliable indicator for a bear market or prices in US stocks. As we can see from the data in 2020 and 2021, CDS were at a low of about 5 before the market slump in 2022. One reason for this could be the fact that CDS only has 15 years of history as a sample size. A reliable indicator should have the following properties: fundamental logic, high accuracy in backtesting, and a long-term time frame. The credit spread, which compares the yield of a corporate bond to the yield of a comparable government bond, is a useful indicator. Widening credit spreads suggests that investors are dumping corporate bonds and moving into treasuries, a risk of trade that could be a harbinger of an economic downturn. The current level of credit spreads is much lower than it was during previous market crises, indicating that the risk of a stock market disaster is relatively low. Another market risk indicator to consider is the price-earnings ratio. As seen in the chart, the PE ratios for the S&P were trading at extremely and significantly overvalued levels in 2020 and 2021 respectively, which preceded the market slump in 2022. Currently, the S&P has a PE ratio of 24 times, slightly above its 10-year average of 23 times. This is a value price level, and the likelihood of a further market crash is low. Overall, investors should be cautious when using bear market indicators and consider multiple factors when assessing the health of the US stock market. While recent bank failures may cause concern, the current valuation of US stocks suggests that the market is not in danger of a major downturn. That concludes today's video. Thank you for joining us, and we'll see you next time on the Magpie YouTube channel.